Trump's 10% Greenland tariff just crushed the silver market. Not because silver's price crashed, but because the plumbing of the market broke. On January 18, 2026, a single tweet quietly rewired the global silver market. What looked like a political move about Greenland was actually a precision strike at the machinery beneath global finance. Not the headlines you saw, the ones you never see. For decades, silver traded as if the world were one seamless marketplace. New York's COMEX and London's LBMA acting like twin engines, balancing each other through silent, invisible swaps. But that engine just seized. A 10% tariff on UK and EU metals turned every ounce moving from America to Europe into an immediate loss. What used to be frictionless arbitrage is now a built-in tax trap. Overnight, New York became a one-way gate. Last Friday, 4.2 million ounces left COMEX vaults, and those ounces didn't just move. They became locked behind US borders. Metal can flow in but not out without punishment. This is the moment silver split in two. New York hardens into a fortress of supply. London stands exposed, stretched thin by Asian demand and depleting inventories. The global balance of power shifts. Without a vote, without a law, and without a headline. You are watching the birth of market segmentation, where geography decides price. And what happens next depends entirely on a single piece of math that no bank can escape. Here is the math that breaks everything. A location swap only works when the cost of moving silver between New York and London is smaller than the price gap between the two markets. For decades, that cost was tiny. Shipping, insurance, financing, barely a speed bump. A 10% tariff turns that speed bump into a wall. If silver is $30 in New York and $31 in London, a bank used to ship metal from the US, sell in London, and pocket the difference. Now that same move instantly loses money the moment it crosses the Atlantic. The price gap would have to be more than 10% just to break even, which almost never happens. So banks stop shipping, arbitrage stops, and the two markets drift apart. Without location swaps, London loses its shock absorber. It can't pull emergency metal from New York when inventories tighten. At the same time, Asian demand keeps draining what little supply it has left. That is why the 4.2 million ounces leaving COMEX last Friday matters. Those ounces didn't just change vaults, they removed optionality from the global system. Every ounce sitting in America now reinforces a domestic bottleneck abroad. This creates a dangerous feedback loop. As London grows tighter, premiums rise. Higher premiums attract even more metal out of Europe, accelerating the shortage. Meanwhile, US prices remain anchored by physical availability, widening the gap further. Two prices emerge: a US price backed by metal and a European price backed by scarcity. This is market bifurcation, not a theory, but a mechanical outcome of tariffs and logistics. Washington has effectively built a strategic silver reserve without declaring one. The tariff doesn't say, keep the metal, but the economics make that the only rational choice. Banks now face a brutal decision: hold in the US or bleed in London. And that is why this moment is bigger than silver. What you are witnessing is not a temporary shock. It is a structural shift. For years, bullion banks treated geography as irrelevant. Silver was silver, wherever it sat. That assumption is dead. A 10% tariff did what decades of market stress could not. It tied price to place. From now on, where metal sits matters as much as how much exists. London will be forced to pay higher premiums to attract supply, which means higher prices for Europe and Asia. New York will trade tighter, cleaner, and more controlled, backed by actual physical metal rather than paper promises. This flips the power dynamic. The US becomes the reference point for physical silver. Europe becomes the demand zone that has to bid it higher. Asia becomes the battlefield where scarcity decides outcomes. Investors who treat silver as a global asset are now holding a regional bet without realizing it. If your metal is outside America, you are exposed. If your metal is inside America, you are insulated. This is not about speculation. It is about logistics, taxes, and incentives, the three forces that quietly run every market. And here is the real turning point. When markets fracture like this, they don't reunify easily. They reunify only after pain shortages, crises, or political deals. Until then, volatility becomes the norm, not the exception. The silver price you see on your screen is already losing its meaning. The question is no longer, what is silver worth? The real question is, where is your silver located? That is the new game. If metals can fracture like this, energy, grains, and industrial inputs can fracture. Next, trade becomes regional, Prices become political, and the old idea of one global market quietly disappears. You are watching that line cross in real time. What you are witnessing is not a temporary shock. It is a structural shift. For years, bullion banks treated geography as irrelevant. Silver was silver wherever it sat. That assumption is dead. A 10% tariff did what decades of market stress could not. It tied price to place. From now on, where metal sits matters as much as how much exists. London will be forced to pay higher premiums to attract supply, which means higher prices for Europe and Asia. New York will trade tighter, cleaner, and more controlled, backed by actual physical metal rather than paper promises. This flips the power dynamic. The US becomes the reference point for physical silver, Europe becomes the demand zone that has to bid it higher. Asia becomes the battlefield where scarcity decides outcomes. Investors who treat silver as a global asset are now holding a regional bet without realizing it. If your metal is outside America, you are exposed. If your metal is inside America, you are insulated. This is not about speculation. It is about logistics, taxes, and incentives, the three forces that quietly run every market. And here's the real turning point. When markets fracture like this, they don't reunify easily. If London cannot reliably access US metal, it must lean harder on Asia and domestic recycling. Both are slow, fragmented, and expensive. That means tighter supply, stickier premiums, and more volatility. At the same time, US inventories become a magnet. Miners, refiners, and large holders will prefer to park metal inside America rather than risk punitive tariffs. Every rational move reinforces the same outcome. More metal stays in the US. Less leaves it. That turns COMEX from a trading venue into a strategic choke point. Paper contracts will still trade, but physical silver becomes the real lever of power. Whoever controls delivery points controls credibility. Whoever controls credibility shapes price. Banks are now trapped in a dilemma they can hedge away. Move metal and lose to tariffs, or stay put and let London tighten. Either choice deepens the fracture. Meanwhile, European buyers will face rising costs, delayed shipments, and sporadic shortages. Asian buyers will push even harder, accelerating the drain from outside the US system. This is how markets break quietly, not with a crash, but with drift, divergence, and dislocation. The headline was Greenland. The real story is control of physical assets. And when control shifts, wealth follows. Zoom out, and you see the bigger picture. This is not just a silver story. It is a blueprint for how trade wars fracture markets. Tariffs don't just raise prices, they redraw financial geography. Once lines are drawn, capital obeys them. In silver, those lines now run straight through the Atlantic. The LBMA can still quote prices, but quotes without supply are just numbers on a screen. COMEX can still clear contracts, but physical metal is what gives those contracts legitimacy. Power migrates to whoever holds the metal, not whoever prints the paper. This is why the 4.2 million ounces leaving COMEX mattered so much. It wasn't panic. It was repositioning. Holders moved toward jurisdictional safety before the door closed completely. Every large institution in the world just learned the same lesson. Logistics can change overnight, politics can change faster, and asset location is no longer neutral. If you store silver in London, you now carry geopolitical risk. If you store silver in the United States, you carry leverage. That shift will echo across gold, copper, energy, and critical minerals in the years ahead. One tariff created a precedent. Taxes can trap metals, and trapped metals create regional power. The market will not look the same again. What comes next will not be announced. It will be felt. Banks will quietly change how they warehouse metal. Refineries will rethink where they ship. Hedge funds will adjust models that assumed a single global price. None of this will make headlines, but all of it will move markets. You'll start seeing persistent price gaps between New York and London, not as anomalies, but as a new normal. Spreads that once vanished in minutes may now last days, weeks, even months. As that happens, trust erodes. When traders no longer believe that metal can move freely, they stop treating prices as interchangeable. Liquidity fragments, risk premiums rise. Volatility becomes structural, not temporary. Meanwhile, policymakers will watch this unfold and take notes. If tariffs can lock in strategic metals without legislation, the temptation to repeat the playbook will be overwhelming. Silver was simply the first test case. The world just learned that logistics can be weaponized as effectively as sanctions. Whoever controls the choke points controls the market, and that reality will shape every future trade negotiation. The price you see today is already outdated. The system that produced it has already changed. If you step back far enough, you can see how this moment fits into a much larger pattern. For decades, the global financial system rested on two quiet assumptions: that metals could move freely across borders and that prices were truly global. Those assumptions were political gifts, not natural laws. Tariffs just reminded everyone of that reality. Silver sits at the center of this shift because it is both a monetary metal and an industrial metal. It lives in the overlap between finance, manufacturing, and geopolitics, which is exactly why this matters far beyond bullion. As the Atlantic divide hardens, you will see three things accelerate. First, supply chains will regionalize. Smelters, refiners, and fabricators will increasingly serve nearby markets instead of chasing global arbitrage. That reduces efficiency, but increases resilience, and markets will price that trade-off. Second, financial products tied to silver will become more complicated. Futures, ETFs, and paper claims that once treated silver as a single asset will have to wrestle with location risk. Contracts that don't specify where the metal sits will feel less credible. Third, governments will start thinking about silver the way they think about oil or semiconductors, as strategic infrastructure rather than just a commodity. In that sense, the 10% tariff wasn't no chaos. It was a signal. It told every institution, location is leverage, and leverage is power. London will fight to regain access, likely by courting Asia more aggressively or lobbying for carve-outs. The United States, on the other hand, now holds a quiet advantage. It didn't need to legislate, simply because economics do the work for it. Meanwhile, everyday investors will only notice the surface: wider spreads, delayed deliveries, higher premiums, and more volatility. But underneath that surface is a new architecture taking shape, a permanent rearrangement of how value moves across the world. Over time, this shift will reshape how physical metal is owned, traded, and protected. Large institutions will quietly move storage closer to their end markets. Some will concentrate in the United States, others in Asia, but fewer will rely on London as the central hub. What was once a single global network becomes three regional spheres competing for supply. That fragmentation changes incentives everywhere. Miners will prioritize where they refine, not just where they extract. Refineries will favor jurisdictions that guarantee market access. Vault operators will market themselves not just on security, but on political insulation. Silver becomes less of a freely flowing commodity and more like a geopolitical asset that lives inside borders. At the same time, the paper market will grow more fragile. When physical metal cannot move easily, futures prices lose their anchoring, spreads widen, basis risk increases, and confidence in paper silver slowly erodes. That dynamic benefits those who actually hold metal and punishes those who only hold claims on it. You will start hearing more about deliverable inventory, eligible metal, and vault location, because those details will decide winners and losers. What once sounded technical will become mainstream, and beneath all of this runs a deeper current. The world is moving from globalization to controlled globalization. Trade still exists, but it is filtered through national priorities. Metals, energy, and critical materials will no longer be treated as neutral. They will be treated as strategic. Silver just happened to be the first visible fracture. The price chart may bounce up and down, but the structure underneath it has already changed. That structure will not revert simply because tariffs shift or as lines fade. The 10% tariff was sold as leverage over Greenland, but its real effect landed squarely on metal flows. By taxing European imports, Washington unintentionally rewrote the rules of how bullion moves between continents. What used to be a technical adjustment in spreadsheets became a hard political boundary on a map. Bullion banks built their entire system around the assumption that New York and London were interchangeable. The tariff turned that assumption into a liability. Every shipment now carries not just freight costs, but national risk. London's position is especially vulnerable because it depends on being the middleman. It survives by balancing east and west, pulling metal from wherever it is cheapest and redistributing it to wherever it demand is strongest. The tariff severs that flexibility. New York, by contrast, benefits precisely because it is now the end point, not the transit hub. Metal arriving in the United States becomes sticky. Once inside, the economics discourage it from leaving. That is why this is more than a trade dispute. It is a jurisdictional chokehold. As long as the 10% tariff stands, every ounce crossing the Atlantic carries a built-in penalty. That penalty forces traders to rethink routes, inventories, and relationships that have existed for decades. The result is a slow but relentless realignment of silver toward American vaults. This is how policy reshapes markets without ever mentioning them directly. One line on a tariff schedule ripples through contracts, shipping lanes, vaulting decisions, and, ultimately, price. Greenland was the headline. Silver became the consequence. What makes this different from past trade skirmishes is permanence of incentive. Even if the tariff were removed tomorrow, the memory of it would linger in every risk model. Banks, refiners, and large holders have now seen how quickly politics can freeze metal in place. Once that lesson is learned, behavior changes for years. You can already see that shift forming. Physical silver is being treated less like a tradable commodity and more like a territorial asset. Holders prefer jurisdictions where movement is predictable, taxes are stable, and exit is not politically weaponized. Right now, that preference tilts toward the United States. For London, this is a slow squeeze rather than a sudden collapse. Inventories do not vanish overnight. Instead, they stop being replenished at the margin. Shipments get delayed, deals get repriced, premiums creep higher, liquidity thins quietly before anyone notices on a chart. Meanwhile, New York hardens. COMEX becomes not just a trading venue but a gravitational center for physical metal. The deeper that pool gets, the harder it becomes for London to compete for supply without paying a premium that undercuts its own market. That is the true impact of the 10% Greenland tariff. Not drama, not spectacle, a quiet, structural tilt of the silver world toward America. And as that tilt deepens, the global price you see on your screen becomes less meaningful with every passing month. As this plays out, the political story around Greenland becomes almost secondary. The tariff creates a simple reality. Geography now defines value. Silver sitting in the United States carries different economics than silver sitting in Europe, even if the metal itself is identical. That breaks one of the last truly global commodities. Market makers who once smoothed prices across continents are stepping back because the risk no longer pencils out. When intermediaries retreat, gaps widen. When gaps widen, confidence fractures. London will increasingly have to compete with Asia for supply, rather than relying on New York as its backstop. That shifts power eastward and makes Europe more dependent on external metal at exactly the wrong moment. At the same time, US vaults become strategically sticky, not because Washington ordered it, but because every trader now acts as if that is the rational move. This is how policy reshapes markets without declaring victory. No press conference, no legislation, just incentives quietly steering trillions of dollars in behavior. And the longer the 10% tariff remains, the harder it becomes to reverse this split. Silver is no longer just moving across oceans. It is choosing sides. The most important shift is psychological. Markets are built as much on expectations as on supply. Once traders believe that silver can get trapped, they behave as if it will get trapped. And that belief alone changes outcomes. Banks will begin pricing a permanent Atlantic barrier into their models. Shipping routes will be redrawn around tariffs rather than through them. Long-standing relationships between London refiners and US vaults will quietly weaken. That means less liquidity, not because metal vanished, but because trust in movement did. For Europe, this creates a slow-burning problem. If London cannot reliably access American supply, it must compete more aggressively for Asian flows. But Asia already absorbs most of the physical market. That competition pushes premiums higher and squeezes European buyers. For the United States, the opposite dynamic unfolds. Every ounce that stays inside its borders deepens domestic liquidity and reduces reliance on foreign hubs. COMEX becomes more physically grounded, less dependent on overseas balancing, and more influential in setting what real silver actually trades at. This is the real consequence of the Greenland Tariff. Not a one-day shock, but a steady reorientation of power toward whoever controls location. And the longer this continues, the more permanent the split becomes. The most important shift is psychological. Markets are built as much on expectations as on supply. Once traders believe that silver can get trapped, they behave as if it will get trapped, and that belief alone changes outcomes. Banks will begin pricing a permanent Atlantic barrier into their models, shipping routes will be redrawn around tariffs rather than through them, long-standing relationships between London refiners and US vaults will quietly weaken. That means less liquidity, not because metal vanished, but because trust in movement did. For Europe, this creates a slow-burning problem. If London cannot reliably access American supply, it must compete more aggressively for Asian flows. But Asia already absorbs most of the physical market. That competition pushes premiums higher and squeezes European buyers. For the United States, the opposite dynamic unfolds. Every ounce that stays inside its borders deepens domestic liquidity and reduces reliance on foreign hubs. COMEX becomes more physically grounded, less dependent on overseas balancing, and more influential in setting what real silver actually trades at. This is the real consequence of the Greenland Tariff, not a one-day shock, but a steady reorientation of power toward whoever controls location. And the longer this continues, the more permanent the split becomes.